Hello, and welcome back to the Smart Portfolio Strategies and Investments podcast. I'm Kerrigan Vale. It's August 25th, 2025, and I appreciate you tuning in ahead of the Monday opening bell. Even though we're technically sneaking this in over the weekend, joining me today is our Chief Market Strategist, Hale Mercer. Hale, welcome back. And I've got to say, those calls you made last week, individual names, spot on, macro read. Not so much.
Thanks, Kerrigan. Good to be here. Yeah, those individual names worked out well, but I'll be honest, even I didn't expect Powell to pivot as dramatically as he did.
But you did keep hammering that employment data story, no?
Right. I kept saying, watch the employment data. And when those job market concerns started showing up in Powell's commentary, it all came together, though the market's reaction was faster than even I anticipated.
Yeah, tell me about it. I was literally running from another morning meeting to catch Powell's speech, and just as I opened my terminal, well, the market was already up 1.2%, and he hadn't even shown up yet on stage. The algos were trading off the advanced text or something.
Same thing happened to me. I was grabbing coffee, came back to my desk, and my Bloomberg was lighting up like a Christmas tree. The bank's subsector was already moving before he said a word. In our sentiment models, when you see velocity and acceleration to such extent, that's institutional money that got the memo early somehow.
Before we dive into this week's data, Hale, for our listeners who might be new to our approach, can you quickly explain what we mean when we talk about sentiment in our analysis?
Absolutely. So our sentiment technology tracks the biggest and most established 1,500 U.S. companies, and we've got historic data going all the way back to each company's IPO. We're measuring sentiment with velocity and acceleration on each level, momentum patterns, sector rotations, essentially capturing how smart money is positioning before it becomes obvious in the headlines.
Aha, and that's how you spotted the bank's acceleration before everyone else caught on. All right, let's set the stage for our listeners. The macro picture shifted dramatically last Friday. Walk us through what happened.
Absolutely. So Friday's session was all about Powell's dovish commentary. He explicitly acknowledged job market concerns and opened the door to rate cuts as early as September. Now, our overall sentiment indicator jumped from 52.14 to 56.62 in just 1 week. That's a velocity of 5.7 with acceleration of 5.87.
Indeed, the market reaction was immediate. Dow up 846 points, S&P within 3 points of its record high.
Right, and here's what's interesting from a sentiment perspective. Both the VIX and MOVE indices are showing favoring risk signals. That's the macro volatility environment telling us institutions are comfortable taking risk right now. Low volatility, accommodative Fed policy expectations. It's a Goldilocks setup.
But Hale, we've seen this movie before. Everyone gets bullish at the same time, and then what's different this time?
Fair question. Look, the difference is in the earnings backdrop. We're not just seeing multiple expansion here. We've got fundamental support. S&P 500 profits jumped 12% in Q2, way above that 5% consensus. That's not hope and prayers. That's actual cash flow.
And that brings us back to earnings. Let's talk about it. Some big names reported this week.
The big earnings stories last week were actually in consumer sectors: Target, Walmart, Lowe's, and Home Depot. Walmart raised their outlook despite tariff pressures showing strong e-commerce and store traffic growth. They missed on EPS, but revenue gains were solid. And that's telling us the consumer is still spending.
But Home Depot was a different story.
More of the same, but Home Depot missed Q2 estimates as consumers pulled back on big-ticket renovations. They're seeing steady DIY demand, but cautious behavior on larger projects. That's the tale of two consumers right there. Necessities versus discretionary big purchases.
And how does that connect to your consumer discretionary signals?
Well, it's nuanced. Our consumer discretionary distribution and retail subgroup is showing 12.51 acceleration, but that's probably more about the rate cut expectations helping financing costs rather than current fundamentals. But overall, we remain bullish, as we'll talk about it later too.
Now, we can't talk earnings without mentioning the AI infrastructure tsunami that's reshaping multiple sectors.
Right. So we've got the OpenAI 500 billion valuation story, Foxconn and SoftBank partnering on data center equipment in Ohio for that massive Stargate AI project, and NVIDIA developing new chips for China. This isn't just a technology story anymore. It's industrial sector exposure, materials for construction, energy for power infrastructure. Our technology sector sentiment is at 62.22 with 8.31 acceleration. But look at industrials at 63.56 with solid momentum too.
Speaking of NVIDIA, we've got their earnings Wednesday. But first, let's get into the sector rotation story that's unfolding right now. What sectors are we buying and what are we avoiding?
Okay, so the clear leaders right now, and I mean trend confirmation level signals, are financials and banks, specifically financials sentiment at 64.59. But check this out. Banks subsector is showing velocity of 19.19 and acceleration of 32.72. That's institutional money flooding in.
And it's not just the big money center banks, right?
Exactly. The regional banks are absolutely on fire. These smaller financials have been leading the charge, and a lot of them are in the Russell indices, which have been outperforming since that Liberation Day meltdown earlier this year. The rate cut narrative is paradoxically helping them because it signals economic normalization and improved credit conditions.
What about the defensive side? Where are you getting cautious?
Consumer staples is flashing warning signals. Sentiment at 45.73 with negative velocity of negative 1.94 and negative acceleration. This sector has been struggling with margin pressures, and we're seeing institutional money rotate out. When defensive sectors start breaking down, it usually means risk appetite is really strong.
Or it means people are rotating out of expensive defensives into cheaper cyclicals.
Exactly. And that brings us to something interesting, real estate. Sentiment is low at 37.96, but the acceleration is 18.31. That's the highest acceleration reading in our entire database right now.
So REITs could be the next rotation trade?
I think so. If we're really getting rate cuts, REITs historically outperform in the early stages of easing cycles. It's contrarian right now, but the momentum is building.
Let's talk specifics. You've identified 3 key picks for this week, 2 trend following and 1 contrarian. Walk us through your thinking. Your first pick is in the industrials.
All right, so first trend confirmation play is United Rentals, URI. Yes, this one's in our industrials bucket. Profit factor of 4.7 with 64% win rate. Construction equipment rental is a pure play on infrastructure spending and economic activity.
And with all this AI data center construction?
That's obvious, isn't it? Every data center needs cranes, generators, specialized equipment. URI is positioned right in the middle of that CapEx boom. Plus, their business model is beautiful. High fixed costs, so incremental revenue drops straight to the bottom line.
Aggressive or defensive positioning on URI?
If you lack industrial exposure in your portfolio, I'd go aggressive on initial position, maybe 2 to 3% portfolio weight with room to add on any pullbacks. United Rentals had performed beautifully in previous trades, and this is a trend that's got legs.
Second trend play?
XLY, the consumer discretionary select sector. Now, I generally avoid ETF recommendations, but the signal here is just too strong to ignore. XLY is 31% Amazon, 17% Tesla, with names like Home Depot, McDonald's, Starbucks, Booking, Carnival. It's basically a who's who of consumer spending.
And the underlying momentum on those big holdings? That's what makes this interesting. Amazon flashed its signal about a month ago, so it's still early in its weekly cycle. Tesla's been gathering real momentum on our daily charts. That's our more dynamic time frame. When you've got both the mega cap engines showing strength, so you're betting on the big players to drag the sector higher?
You can say it this way too, but those retail earnings showed the consumer is still strong. Look, discretionary sector delivered plus 35% in both 2023 and 2024, but it's been underperforming this year as everyone chased AI and rate cut trades. If we're really getting rate cuts, consumer credit gets cheaper, holiday season setup improves, and this becomes a catch-up play with serious momentum behind it. If you look for more confirmation, watch some more of the upcoming earnings. GAP, Kohl's, Urban Outfitters, all are this week.
And your contrarian pick, TSN, Tyson Foods. That's interesting, given the weakness we're seeing in consumer staples.
Yeah, this one's going to raise eyebrows. Here's the thing. Our contrarian approach values TSN with above 65% chance of success, even with that 2.48 profit factor showing current weakness. We're stepping into some value analysis territory here.
What makes you think it's oversold?
Several things. First, Tyson has a 14-year streak of dividend increases with a current yield of 3.47%. That's quality income in a volatile market. Second, the stock price is cyclically depressed, but there's a longer-term structural story developing. We've also seen live cattle prices rising for the past 2 years, which typically leads to higher protein pricing with a lag.
When you say situation, you mean the labor situation?
That's right. If we keep seeing large-scale deportation of undocumented workers, food processing and agriculture will be hit hard. Labor costs spike, food prices go higher, and suddenly Tyson's pricing power returns. It's not a pleasant topic, but it's a real economic factor that could force protein prices significantly higher in the mid to long term.
So you're positioning for a potential supply shock?
I'm positioning for multiple scenarios: cyclical protein recovery, dividend income, and yes, potential supply disruption. This is a few-month holding, not a trade. Small position size, and the only thing that would make me sell is if something fundamentally changes with the company itself. Operational issues, management problems, that sort of thing.
Position sizing strategy?
Defensive on TSN, smaller position size for a contrarian play that needs time to work. URI and XLY, I'm willing to be more aggressive because the trends are established and accelerating, but again, these are all multi-month positions, not day trades.
All right, let's talk about the week's main event, NVIDIA earnings Wednesday after close. $45.92 billion revenue estimate, up 52% year over year. Hale, that's a massive number. And honestly, after missing the Fed call last week, are you feeling pretty optimistic about this one?
Looking for a redemption call, huh? Well, I'm actually with you on this one. It's almost incomprehensible. $45.92 billion is bigger than most S&P 500 companies' entire annual revenue. But our semiconductor subsector sentiment is showing 12.93 velocity with 13.73 acceleration, and both SMH and XLK are flashing really positive readings.
So the sector momentum is there?
Absolutely. When you see both the SMH ETF and the technology select sector XLK showing this kind of institutional flow, it tells me smart money is positioned for a beat. The AI infrastructure spending theme we talked about earlier, that's all flowing through NVIDIA's numbers.
But the expectations?
Sure, estimates are up 52% year over year, and the stock's already had a massive run. But here's what I think everyone's missing. The guidance will be key, not just the beat. If they can show visibility into 2026 AI infrastructure spending, this thing could really surprise to the upside.
How are you positioned?
I like the sector exposure through SMH and XLK rather than trying to time NVIDIA specifically, but I'm definitely more bullish than bearish going into the print. The sentiment data is just too strong to ignore.
Hale, I've got to ask the question everyone's thinking, but nobody wants to say out loud. Are we at a market top? We've got extreme valuations. Tech stocks have gone vertical since April. VIX is suppressed below 14. Volatility is super cheap. It looks like everyone's bullish and all in.
Look, I get the bear case. Those are classic topping signals, expensive valuations, vertical price action, complacent volatility. The everyone's bullish narrative sounds compelling, but here's what the crash predictors always miss. Sentiment is elevated, sure, but it's not at extreme levels yet.
What do you mean by extreme?
Remember November 2021 when the market actually topped before the 2022 bear? Our sentiment readings were stepping down from above mid-70s levels for weeks. And funny enough, that was right around NVIDIA earnings too. But the key difference, sentiment was already rolling over while prices kept grinding higher. That's the divergence you watch for.
So where are we now versus then?
We're at 56.62 sentiment with accelerating velocity. That's elevated but not extreme. In 2021, we were seeing deceleration from much higher levels. Right now, the acceleration is broad-based. Financials, industrials, technology, even real estate starting to turn. When you get multi-sector momentum like this, tops usually happen from exhaustion, not from here.
But what would change your mind?
Well, if I see our velocity readings start decelerating while sentiment stays elevated, or we push into the mid-70s, even 80s territory, and start seeing single sector dominance again. But honestly, the bigger risk might be getting too cute, trying to time a top instead of riding the trends.
So respect the bear case, but don't fight the momentum.
It is. Stay humble, manage risk, but don't fight momentum just because the VIX is low. Markets can stay irrationally exuberant longer than bears can stay solvent.
All right, Hale, as we wrap up, what's your primary focus for the week ahead beyond NVIDIA?
Several things to watch. We've got more retail earnings coming in. Those will tell us how the consumer is really holding up after the mixed signals from Walmart and Home Depot. I'm also watching sector rotation carefully. If financials can hold these momentum readings through any NVIDIA volatility, that tells me the rate cut trade has real legs.
And the big data release?
Friday has Bureau of Economic Analysis releases the personal consumption expenditures price index for July. That's the Fed's preferred inflation measure. And with Powell's dovish pivot last week, this could really drive Wall Street's reaction to rate cut timing, much more important than any technical levels right now.
Also keeping an eye on REITs?
Absolutely. If real estate starts participating in risk-on moves, that could be the next big rotation theme. The acceleration readings are already there. For more on this, check out the full report at spsi.substack.com.
Any final thoughts for our listeners?
Yeah, don't overthink it. The data is telling a pretty clear story right now. Fed's turning dovish, earnings backdrop is solid, and multiple sectors are showing momentum. Focus on the fundamentals and let the sentiment guide you.
Perfect. Hale Mercer, Chief Market Strategist, thanks for joining us.
Always a pleasure, Kerrigan.
And that's it for episode 2 of Smart Portfolio Strategies and Investments podcast. Check out the description links to full sentiment analysis plus individual stock signals. I'm Kerrigan Vale. Trade safe, trade smart, and we'll see you next week.
Investments include risk and loss, including loss of principal. This podcast is for informational and education purposes only and should not be treated as personalized financial advice. Smart Portfolio Strategies and Investments, or SPSI, may have active positions in the financial instruments discussed. Past performance does not guarantee future results.